Welcome to What's in Store, the show where we cover hot topics at the cross-section of retail and real estate. I'm Karly Iacono, and I'm joined by my co-host, Chris Ressa. Chris, great to see you. How are you today?
I'm doing great. How are you?
Living the dream, loving summer, playing lots of golf. Life's good. How about you?
I played more golf last year, but I'm getting back into the swing of things with golf. I am...
No pun intended.
No pun intended, actually. They say like you can pick up where you left off. I'm like where I was in August of last year, not where I was in like October. I was hitting the ball pretty well in October, so I'm trying.
It's month by month for you?
Yes,
That's specific?
That's where I'm at now.
I don't think I'm at that level yet. Okay. I'm not good enough to be competitive, so it's
Me
just
either.
fun. But I think when I start to get better, then I'm going to take it serious, and it's going to be a whole different world.
Well, I'm not competitive with anybody I'm playing with. I'm competitive with myself in trying to improve, right? I want to be out there and be like, oh, this person can play golf. And
right. Well, that's the goal.
Right?
Yes.
Yeah.
Not quite there, but happy to say I went to my first outing. It was all commercial real estate people. It was fantastic. So excited to get out there more.
Awesome. Taking lessons?
Absolutely. And when I told my instructor I was going to my first outing, he went, oh, when? And I said, in 2 days. So what are we going to do for the next hour to make this work? But all jokes aside, it went well. It was great. So no complaints.
Awesome.
So we have a lot to cover. We're just coming off ICSC Las Vegas, which was record numbers for the show. We want to talk about that and then really take our takeaways from ICSC and kind of extend that forward into what we're seeing for the rest of the year.
Let's do it.
Start off with, and I know the answer already, but tell everyone listening, how was ICSC for you? Just broad picture.
I think from my vantage point, it was really good. You know, most of my meetings were with retailers, and very positive because retailers are dying to open up stores. So that was great. I think I have like 3 big takeaways from ICSC Las Vegas. So the first one I would say, and I don't know about you, and you could comment on this as well, is I didn't hear the R word at all. Recession. Did you hear the R word?
The dirty 4-letter word that it's way more than 4 letters. I did not.
Yeah.
I did not hear it once. That's a great point.
So I think that was good. And sometimes there were some not stellar earnings reported coming into Vegas, and that usually rings people's head, about like, oh, are we going into recession? And there's some headline news about consumer debt and a bunch of other things. And so I would have thought I might have heard it, but I didn't hear the R word. So that was a surprise.
Encouraging.
Yeah, I thought I might hear the R word, and then we didn't. So that was one. 2.
Wait. I think I get to jump in with one.
Sorry.
You can't just do all 3. And
Go.
Go. Gotta keep you in line. Okay, so one thing, the elephant in the room that, of course, everyone was talking about in my world was interest rates.
Right.
And when is the Fed going to cut rates? So, of course, if we knew all of this, we would be rich, famous, and good looking, but we don't exactly. So I think the consensus is 2 rate cuts. At least that's what CBRE is putting out. I personally feel like we might only have 1. Fine. Nobody's really that excited about talking about exactly when rate cuts are going to happen. It's more, what does that mean for the market? And I think the interesting shift that I felt at Vegas and believe will continue through the end of the year is even if we get a 25 basis point cut in September, that's not going to materially change pricing. Even if we get 50 basis points by the end of the year, I don't feel like that will be a true impact on cap rates and pricing overall. So there was an acceptance of market conditions, although a lot of people wish they were different on one side or the other, depending whether you're a buyer or a seller in this market. But there's an acceptance that maybe this, interest rate bailout that a lot of people were hoping for of 100 basis points this year is just frankly not going to come. And pricing, even if we get a modest cut, is what it is. So that I felt like was a big shift from the wait and see until everything changes mantra that we had last year.
Is that another way of saying that you think the rate cuts are already priced in?
Such a good question. It really depends on the property type. In some cases, I don't think interest rates have been priced in enough. We still have a lot of negative leverage deals. In some cases, I think they have, and we're seeing spreads really widen. So that was a very political sounding answer. I know it depends is the true answer. But I think that for the deals that the sellers were waiting for interest rate cuts before they became realistic on pricing, they might be sorely disappointed that that 25 basis point cut does not make buyers suddenly want to take a neutral or even negative leverage deal, because there's still a lot of that product on the market.
I do think interest rate cuts will open the pool of buyers, because there will be deals that if you got a 50 basis point cut, that is, enough for some deals to make it work or not work. So I do think it'll open the pool of buyers. Will it impact pricing? I don't know, but I think it'll open the pool of buyers if that happens. We'll see.
Well, I think there's that inflection point, right? Some deals are still negative leverage, and maybe they're upside down by 75 or 100 basis points. So 25 in that case isn't going to be material, but some are already neutral or, slightly positive. So I think that would make buyers jump in more.
Yeah.
And it also kind of signals the bottoming of the market, which I think is important too. So it's not that it's irrelevant if the Fed cuts rates. It's just I don't think it's going to be the huge windfall and prices are going to shoot up and cap rates are going to tumble down as soon as that happens.
I think when you bought matters so much today, right?
So true.
If you bought in 2021, that's different than if you bought it in 2014 and you're trying to sell it. So
Right. Yep.
Yeah.
All right. Well, now jump in with your number 2.
So my number 2, use the acceptance of market conditions. What I would say is, we talk about on the store side, the supply and demand for space, and that there's no supply and there's excess demand. That's still true. And last year in Vegas, that was talked about a lot. But I hadn't really seen it in a significant way translate into terms. It translated into more spaces being leased. And so maybe we had to chew up some space. But I think now there's an acceptance that landlords have some leverage because of the lack of supply. And, I heard retailers talking about saying things like, I'm going to do what I have to do to open up stores, which I hadn't heard before. And I think that is a big shift. And, we spent from, and I don't think it's all going to happen at once. I think it's incremental. It spent from, call it 2008 to 2019 of the commercial lease in retail, got more tenant friendly year by year, terms swaying. And so it won't shift overnight, but I think it's starting to now. So every lease that gets done, you'll see it start to balance out a little bit more as more and more leases get done. And I think that's a good thing to get a little more balance than it was because, some of the provisions were pretty tough you had to do in 2009 to make deals. And you don't have to do that today.
Is there one provision or one part of the lease that you think will shift the most as this competition for space continues? Or is it just overall lease form?
I think, the thing people focus on the most, the one term, is rent, right? So I think rent growth is happening. And I think the other side of that is cost. And so, but if we take that aside, I think the next piece of it is two things that relate to time and flexibility. So I think that's the things that for long-term holders concern them the most. And those are the things that were, really in the tenant's favor in 2008 to 2019, when there was early termination rights, flexibility around things like assigning the lease, flexibility around a whole bunch what might cause a remedy rent, whether this is a co-tenancy exclusive. So I would bucket it into two categories where the flexibility is going to be less for the tenant and the time is going to be more favored for the landlord, whether that's free rent periods, whether that's time to get open, right? Things like that. And I think time to get open is one where everyone wants to get open sooner, yet the lease allows for these significant time periods to get open. And I think that is, it's wearing on everybody.
Is there one point of friction that you would like to see ease between landlords and tenants in terms of the lease structure or the timing? Is there one thing that you're like, if we could just come to a meeting of the minds on X, the process would be smoother?
I think the biggest, it wouldn't be necessarily on timing and flexibility.
Okay.
It would be on the balance of landlord and tenant work to get the store open. I think that is the biggest one in both time and cost, and what the actual scope of work is and the deliverable is changing every day. And it is a really, really challenging thing to get through. It is, if you talk to a leasing person, they would tell you it's where they're spending the most time right now is the work letter.
I've heard that actually referenced from quite a few guests that we've had on the podcast, saying what is as is anymore, right? Does it mean no violations? Does it mean utilities are working? Or does it mean just as is, you get what you get, good luck? So, even things that you didn't think you had to second guess in terms of tenant landlord work are kind of coming into question.
100%. Yeah.
Really interesting.
The LOI will say as is, and then the lease will come and there's a landlord work letter,
Right.
and you're like,
I thought I said as is.
yeah.
No.
But you have to provide these base conditions, Chris.
Right.
And I'm like, well, some of those don't exist, so it's not really as is.
Then it's not a base condition if it's not there already. So I could see that going back and forth. But better to outline it on the front end probably than have to deal with it later.
Yeah.
Interesting. So my second takeaway is just on where activity is in the market. Second thing I'll share. So there are 3 buckets of buyers who are active right now. And as you and I were chatting earlier, thankfully transactions seem to be picking up. We're getting more LOIs. We have a lot of deals coming to market, which is great. But there are more looks on the deals that we're bringing to market, and there are more actual offers coming in. So all very positive. Still big spread between bid ask. It's not easy, but I do think things are starting to shift a bit. And the pools of buyers that are getting things done are, one, anybody who's buying cash, which is typically your private client, $4 million and under. So the small deals, the QSRs, some of the discount stores, those are still moving with cash buyers, although, of course, they're not plentiful, but they're out there. The second bucket are yield buyers. They're looking for a spread between interest rates and cap rates. They're looking for positive leverage. And, it could be any different number of investment thesis. It could be long-term lease with a lesser known tenant. It could be credit, whatever their thesis is. They're looking for financing that works and a positive spread. So that's where all of your 7.5 cap rate plus deals are moving, because you can get, debt in the high 6s to low 7% range. So those deals have a lot of activity, which is great. And then the third bucket is really interesting, and I would argue this is probably where you come into play in your company a little bit more, and that's the more professional buyers who say, we don't really care what the cap rate is. That's just a number, right? That's a quick snapshot in time. I mean, you care, of course. And
I was just going to say.
No one wants to overpay.
we
Chris is
care
like,
about cap rates.
We don't overpay. I'm not saying overpay. Let me finish the thought. Okay, I knew that was coming. But what is the true return on the property? So what other levers can you pull on that asset? So your cap rate could be a 4 cap on in-place income, but maybe the center is 60% vacant.
Sure.
That's not really a 4 cap. That's a whole strategy going into that. So cap rate matters less, not at all, we'll say, if there are other levers to pull. So are you kicking a tenant out and raising the rent? Do you have an LOI for a vacant space already in hand? Like, is there a way to work that asset to make it make sense in 6 months or a year? And that's the more strategic buyers that are out in the market really looking for opportunity and trying everything they can to find it and put money out. There's not a lot of vacancy in the market, as you know, so it's a bit challenging to find.
That's the piece that's challenging.
To find the properties where you can do this repositioning, but that group of buyers is very active as well. So I think the one thing that's slow still are trade buyers, and those are the ones who, are coming out of typically other asset types into net lease and into neighborhood retail, and they're looking for just placing those proceeds. That market is still slow because it's heavily reliant on other asset trades. So when that comes back, I think we'll all be very happy, but we are grateful to have the other three buckets sort of, dipping their toe in again.
Got it. Okay. I love that articulation of the different kinds of buyers out there. So the third for me is franchising.
Okay.
I think that franchising has to be one of the biggest, and the growth in franchising, one of the most significant impacts to retail real estate in the last 20 years. And I would argue majority of it positive. If you look at, there's all these new concepts. One of the reasons is because they're franchised. That's how they can grow so quickly, and they can grow at scale is through the franchise model, especially when you think about, some of the other forms of venture capital and all this stuff that either is on the sidelines or more expensive today. And it's not just on the small shop, right? You think about retailers like Planet Fitness and Sky Zone, and now we have pickleball franchises. There's a ton of franchise concepts that have chewed up space. And generally speaking, we've always had local tenants in shopping centers. The biggest difference today is now they have a brand name on the door versus their whatever their local concept name was, 30 years ago. And we still have the local tenant, of course. But I think, I was walking around the floor for a bit, and I couldn't believe the amount of franchise concepts that had booths and were trying to scale up. And I think franchising is, been a big boon for the retail real estate industry, and the growth in franchising has certainly helped. Go ahead.
Does that scare you at all as a landlord in terms of watering down credit if there's less corporate expansion and it's all, not all, but heavily driven by smaller franchise concepts? Or do you love the new diversity of tenants because they can grow faster and we have all these new concepts, or both?
I didn't say we had less corporate expansion. I just said we had explosive franchise expansion.
Okay.
So I think that, you can, would you rather have a local hair salon or a Great Clips? That's the choice today, right? And the answer is, I think it depends.
Right.
Love them both. But now you have more options as a landlord because of the explosive growth of franchising over the last 20 years. And I think, I don't have the stats, but it's just astounding how many franchises there are in the world today, and they keep coming on. And they're also incubating like new concepts that are making shopping centers diverse that maybe wouldn't be able to grow if it was just a local entrepreneur. And now that they're, to that corporate, to be the next Chipotle, which is a corporate store. So there are way more successful franchises than we give credit for. And some of them are more sophisticated operators. You know about all the multi-unit operators who in the franchise world. There are groups out there that have hundreds of thousands of franchise stores. So that credit profile is just as good, if not better, than some of the corporately owned stores.
Very true.
So I think this is really interesting. It's obviously played a big part in occupancy in America. And overall, I think it's a good thing. But I'm shocked we're not talking about it more, because you go to any shopping center in America and there are franchise concepts in it today, just about, and almost every one.
Do you think that is the more sustainable way for the small business to grow? I guess the second piece to that is, how egregious are these franchise fees? I don't know the answer to that, but is it always a better path because you're standardizing a concept, you have branding behind you, et cetera? Or could it be that maybe you're giving 20% or whatever the number is of your sales to XYZ company, and that makes it harder to turn a profit?
I think a couple of things. I think one, they're all different from a fee perspective.
Okay.
Right? And I think when you're looking at the ways that you can scale a business, I think the first thing is like, should this business be scaled? There are some businesses that are great businesses, but and like they say this on Shark Tank all the time, but it's $1.5 million business and it shouldn't be $100 million business.
Right.
And it can't be $100 million business. Right. And so scaling a business that doesn't have, a bad business isn't a good idea. So let's put that out there, right? Like I think that's scaling a bad business, or even scaling a business that maybe doesn't work on a national scale or in multiple markets. Not a great idea. There are some great businesses, high margin businesses. They're $1 million business, throw off a great cash flow, but they shouldn't be $100 million business. And then I think you look at, okay, let's take the business that can scale, and what are the paths to do that, right? You can raise equity. It's harder now. You can lever it up. Or you can franchise. And there are other ways, obviously. You can use cash. But franchising there's a process to, get through to be able to franchise. But, a lot of people are navigating now. There's a lot of education around how to do that and set up to be a franchise. And I think it's here for a while.
Sounds like a net positive then.
I think it's
operator.
a net positive.
And as a side note, I think it would be a lot of fun to set up a Shark Tank style day for DLC when you have an opening in one of your shopping centers and have all the tenants and franchise concepts come in and do their presentation in a set amount of time, Shark Tank style, and you and Adam can rate them and decide if you want to invest.
So
I'll be involved as well, just so we're clear.
There is a lot in like the mid 2000s. There was a lot of talk about that to like Shark Tank spaces.
Right.
I haven't heard of too many stories where it was successful, like, to incubate concepts, like have a restaurant week where have find all the restaurants who want to open up a location, great chefs, have a restaurant space, make it give away a space or something like that in order to get the greatest operator and find the next, Guy Fieri. I hadn't heard of like it really like translating to massive success. I'm sure there's some, but yes, I've seen the Shark Tank idea for spaces.
That's interesting.
Yeah.
All right, so maybe we won't bring it back just yet, but we'll keep noodling on that idea. The last takeaway I'll share today is something I've touched on recently, and that is an increased focus. I think last month I mentioned this on retail fundamentals, on the underlying real estate, and I think you were shocked because from the multi-tenant acquisition side, that's the first thing you look at, right? And I shared that often we will value the lease term and the tenant and the credit profile even before we factor in where it is in the U.S. As inventory builds, which it is in net lease, it is in unanchored retail, as inventory builds, the underlying real estate fundamentals become even more important. And also, as tenants continue to try to grow in supply-constrained markets, lack of available space in the competing area gives more security to the assets, of course, that are already built. So we've got a few things factoring in that buyers have a lot of choices for net lease and unanchored retail in a lot of cases. And as they're sifting through that inventory, I'm having more conversations that maybe the less risky move is to buy a midterm lease, a little more yield, but get that A location that you really want and feel good about, that over time you can boost rents instead of get the 15 or 20-year deal in small town USA where we're not sure what the growth trajectory looks like. So it's just a mental shift in prioritizing the deal analytics, which is interesting.
Got it. And so you were right, that continued in Vegas. That was definitely...
Absolutely. And a lot of the meetings as we're going, because we have a ton of deals on market right now, was, okay, what are the demographics? Where is that? What's the closest traffic drivers or university nearby? Is there this? Instead of, oh, interesting, what's the yield? And tell me more about the tenant if it wasn't a tenant that the buyer was already used to. So the focus, and again, this is not new. Real estate fundamentals have always been important, but now I think we're leading with that, whereas it used to be one of the other points, kind of in the middle of the conversation.
Right.
And as inventory tightens, that will kind of come back into balance. But right now, it's a huge factor as to whether or not a deal has a lot of offers or it doesn't, and it's harder to move. So,
got it.
Interesting shift.
For sure.
And what is your last piece of wisdom you'd like to share with us today?
Well, I think one of the things I think that is interesting is, and I talked about this recently with the guy Simeon Siegel, is that the normalization of retail again. And I think that today we like to say when like a retailer is doing good or bad, we like trends and patterns. And so we say it's something from a macroeconomic indicator, and that's why the retailer is doing good or bad. More often than not, the reason that the retailer is doing good or bad is because of their execution and how good of a retailer they are. And we don't give that enough credence. And I think because there's moments in time where that might not be the case, right? When we talk about like the past few years in a supply constrained environment, like you might not have had to be that good. You just needed to have the product available. Like I'll never forget, I was looking for diapers in COVID and they were saying 3 weeks. And I'm like, online, and I'm like, well, how does that work? And
it's not going to be pretty.
So where was I going? Like, it wasn't my retailer of choice. It was who had diapers. Right. And so now that we've waded through all that, like, and we're not talking about the R word. And now I think it's like what retailers are connecting with their consumer, have excellent leadership, have operational excellence, and have a product and service that people value, those retailers are winning. And those are like the fundamentals of retail. And I think that's a good thing. I think the people who have all that want that to be the differentiator and not just some availability of product, right? Like,
right. It seems kind of unfair if that's the rule,
right?
If who can get the toilet paper faster,
right?
The sale, not like who makes a better product at a better value.
You know what I mean? Yeah. So I think that is a good shift. And so, the point I would put out there is, don't just take like a retailer not doing well as some major macroeconomic trend. Sometimes businesses, they're living, breathing things. They're not working right now and they need to be fixed, or sometimes they're gone forever. And so, and it might not be because of the macroeconomics. It might just be that doesn't work right now or might not work anymore. And the ones who are winning, we should look at, is it because of their execution or is it because of, some outside force, right? And so I think that's a good thing, and that'll be, clearly a differentiator in all these new concepts that have come to life, like who's good.
No more excuses. That's what I'm hearing. Either the brand and the business works and it executes on a good product, or it doesn't, right?
Yeah.
Age-old capitalism. So glad to hear we're getting back to that. And it does seem like it will make retail stronger overall.
Yeah.
Take out those, I guess, external excuses.
You know what I mean? And or external positive forces, right?
Right.
You know what I mean?
Propping up the business or,
right.
Right.
We had all this free money enter the system, right? That was just this excess cash to go. And now we've been through quantitative tightening where money's come off the sidelines. So I think, retailers who execute are going to be just fine.
Continually improving asset type. One that I know we're both very bullish on. And I think all those factors come together to make a really, truly nice, stable, quality product.
Yes.
It's a great business to be in.
For sure.
And I think on that note, we will wrap.
Awesome.
Good stuff. To everyone listening, that was What's in Store with Karly and Chris. We are so happy you joined us, and we will see you again very soon. Thanks so much, Chris.
Thank you.